We've covered how to trade. Now we cover how to stay in business. Lesson 6 is the most important lesson in this entire course: money management. You can have a 90% win rate, but without this, one bad trade will wipe you out. Let's talk about how to protect your war chest. Look at these two scenarios. Scenario A: you risk 1% per trade. Your growth is steady and drawdowns are manageable. This is how you compound an account into a fortune. Scenario B: you risk 5% to 10%. One bad week leads to emotional decisions and an inevitable account blowup. Final takeaway: risk control creates growth, not the other way around. You don't need big wins to be a millionaire. You need consistency and the discipline to let small gains compound over time. Protecting capital is your number one priority. You have to realize that the math of losing is anti-growth. If you lose 1%, you only need 1% to get back to even. Easy. If you lose 50% of your account, you don't need 50% back. You need a 100% gain just to get back to where you started. If you lose 90%, you need a 1000% gain. The goal isn't to get rich tomorrow. The goal is to stay in the game long enough to let the math of the TI system win. Discipline isn't just a virtue, it's a requirement for survival in these markets. No matter how good a system is, you must trade under the assumption that a streak of 8 to 10 losing trades will happen eventually. It's a statistical certainty. Look at the math. Scenario A: if you risk 0.5% per trade, 10 losses in a row is just a 5% dent in your account. You only need a tiny 7% gain to be back at break even. Scenario B: but if you risk 5% per trade, those same 10 losses wipe out 50% of your account. Now you need a 100% miracle gain just to get back to where you started. The lower your risk, the easier your recovery. High risk destroys accounts. No system can protect you from that. Let's define our standard operating procedures. For day trades on the 1 hour or 5 hour charts, we recommend a standard risk of 1% per trade. For long-term swing trades, you can push this up to 2%, as the volatility is smoothed out over time. However, when you move into the high-frequency world of intraday trading, the 12-minute and 3-minute charts, you must scale down your risk to 0.25% or 0.5%. Because the moves are smaller and more frequent, you want to keep your risk exposure light. Never risk too much on a single idea. To protect your war chest, we use a monthly circuit breaker. If you reach a maximum loss of 6% in a month, you stop trading. Period. You take a break, reset your psychology, and wait for the next month. Now, there is one exception: high confidence trades. These are AAA setups with extreme confluence on the daily chart. For these major market reversals, you can go up to 6% total exposure. But this is the exception, not the rule. Use this leverage carefully. It is a scalpel, not a sledgehammer. One of the biggest mistakes beginners make is basing their trade size on their account balance. In the TI system, your risk defines your position size. Before you enter, you must calculate the entry point, the stop loss, the invalidation level, the position size, how many contracts you buy so that the distance between entry and stop equals exactly 1% of your account. We only take trades where the take profit is 2 to 3 times the distance of the stop loss. If the math doesn't work, we don't take the trade. This visual represents our ideal setup. We are looking for a minimum 2 to 1 or 3 to 1 risk-reward ratio. Position sizing isn't a set it and forget it game. We practice scaling. Don't go all in at once. Scale into the strength of a move and scale out as you hit your Fibonacci targets. By taking partial profits and trailing your stops, you ensure that a winning trade never turns into a losing one. Discipline is what separates the top 1% from the rest. Limit yourself. Max 3 to 5 trades per day. Quality always beats quantity. Avoid the big three: overtrading, rage trading, and revenge trading. These are account killers. Journaling. If you trade multiple markets, keep a journal. It will tell you exactly where you're making money and where you're wasting it. Start by mastering one contract, like Bitcoin. Once you are consistently profitable there, then and only then add others. The late Mark Douglas, a legend in trading psychology, identified the three most costly mistakes: not defining risk in advance. If you don't know your loss before you enter, you're gambling. Not limiting losses. Hoping the market will turn around is not a strategy. Not taking profits systematically. Greed makes you hold until the move reverses. These errors are expensive. By following the TI system's Fibonacci targets and stop-loss rules, you are mathematically forced to avoid these mistakes. We wrap up with the philosophy of Dr. Alexander Elder. Your goals as a trader must be prioritized in this exact order: survive, live to trade another day, grow capital steadily, focus on the slow and steady equity curve, achieve large gains. This happens naturally once you've mastered the first two. You are your own boss. You have the freedom to only trade the best opportunities. Think like a professional. Be selective, be disciplined, and let the system do the work for you.